All right, episode 1 of the NQ Mastery course, IPDA Market Profiling. So why is profiling the market so important, and why have I placed this as the very first episode? Okay, like I said, nothing is random. On index futures, the market consolidates 52% of the time and expands 48% of the time. So we all know we don't trade a consolidation. So if the market is going to be consolidating half the time, right, it's important to be able to profile the market so you know when you're not going to be in the market and get chopped up, and you know when you should be going into the market to then find an expansion and trade that. The understanding of market profiling is also extremely important for the equity open 9:30. As we approach the 9:30 a.m. on a short-term perspective, right? Market profiling is actually the first step, okay, when we're going to be looking at the equity open and how to trade it. So this is really, really crucial. IPDA, the interbank price delivery algorithm, has 4 market profiles, right? There's nothing else it does. It's either in a consolidation, right, accumulating. It's either in an expansion. It's either in a reversal or it's in a retracement. Technically speaking, okay, this means the market is only ever in one of 2 states, ranging or expanding. And that's because consolidation is ranging. Expansion, reversal, and retracement, even though they're doing different things, right, in how we trade them, they're still technically expanding, right, because they're not ranging. The market always goes from consolidation to an expansion. The market never goes from consolidation to reversal or consolidation to retracement. Again, this is really, really important because we're going to use this logic to help us catch that 9:30 a.m. move. The market always starts its cycle with a consolidation. What do we do in a consolidation? When the market is in consolidation, there is only 2 scenarios that can take place. Number 1 is a breakout of the consolidation in the direction of our bias for a retracement long or short post breakout. Number 2 is a stop run of the consolidation in the opposing direction of our bias for an AMD pattern, right? Which most of you will be familiar with, right? So this is one of the 2 things it can do, right? So we go from a discount key level here. We have a drawn liquidity above us. If the market goes into consolidation, right, we wait here. We're waiting for one of 2 things, right? In this case, the market breaks out of the consolidation, then it retraces and expands, right? Option number 2, the market is in consolidation. It gives a false breakout, stop hunt for an AMD, and then it expands, right? So in consolidation, you do not participate in the range. You just wait for one of these 2 to happen. Of course, this is crucial to know the drawn liquidity as well, which you will learn in the long-term perspective. Okay, premium key level, right? Bearish example here. Consolidation, if we're looking for downside, we either wait for a pop above the consolidation. If that doesn't happen and we see an expansion, a breakout, we look for a retracement and then an expansion. Or it goes above the consolidation first, right? Runs the stops, breaks down, then gives a retracement and then expansion. And that would be our AMD, bearish AMD, right? The market, like I said, is always either trending or ranging. We want to position ourselves in the market when it's trending. However, when the market is ranging, it helps us to predict when the market is likely to be trending. Why and how, right? The market has only 2 sequences, okay? A reversal sequence and a continuation sequence. Under a reversal sequence, like I said, everything starts with a consolidation. Reversal sequence goes accumulation, expansion, reversal, retracement, expansion, okay? Continuation sequence goes accumulation or consolidation, expansion, retracement, expansion, which was in the past 2 diagrams. But now let's look at some charts. Let's first look at what a reversal sequence looks like. So everything starts with a consolidation, right? This is the NASDAQ, of course. So the market starts with consolidation. Like I said, when you have your bias and the market is in consolidation, you wait. And if you're looking for a reversal, right? So if it's bullish here and then starts to accumulate and you're looking for downside, you know it's not going to sell off from a consolidation. Why? Because we never go from consolidation to reversal. But now here is the sequences, right? This is a reversal sequence. Consolidation, expansion, reversal, retracement, expansion. Continuation sequence. consolidation, expansion, reversal, retracement, expansion. So that is our reversal sequence in play. Now we want to look for a continuation sequence. Consolidation, okay, expansion, retracement, expansion, right? So these are the only two sequences the market has. And when you see that consolidation, this is all that's really going on, okay? So you're looking at that AMDO breakout and you're looking at two sequences to play out. If you're looking for a reversal to happen, this is the sequence right here, right? And if you're looking for a continuation to happen, this is the sequence in which a continuation will happen. These are the market cycles that cause these two sequences.